So yeah, we studied the rule of double entry, and these are a few transactions that we will do. After we are done with this transaction and these steps, then I will start specific chapters. Yeah, to answer your question. Even though I told you in the beginning, and I will tell you that when I start a chapter specifically. So yeah, the requirement of the question is: do double entries of the transactions above, post them to general ledger accounts, balance the accounts, and prepare a trial balance. Okay? So, one by one, we will answer. First step, we will do the double entries of these transactions. So, Hamad starts business on 1st January 2015. The following transaction take place during the month of January. Actually, I wanted to write here 2015. No, actually, I prepared this in 2014, but I changed the above date to 15, but I forgot to change this below to 15. Yeah? So this is actually 15. Okay. So these are the transactions that happen. First transaction is he invested 100,000 into the business. Remember, if we look from the business perspective, what is happening? The cash is affected, yeah?
Yes, exactly.
So let me write that rule that we studied. I said asset,
Yes.
an expense,
Increase debit.
increase debit, decrease credit. And income,
Yeah.
capital, and liability.
Increase credit.
Increase and decrease. So the increase of this is debit, the decrease of this is debit, and the decrease of this is credit, and increase of this is credit. So I will give this a red color. So that you remember it visually. Yeah? And let's change this arrow to blue. Yeah, so from the first transaction, he invested cash into the business. And remember, what is happening to the cash? Remember, cash is an asset, yeah? And assets are debit by nature. And in this case, it has increased. According to this rule, the increase of a debit is debit. Yeah? So debit, cash. And what should be credit? Yeah? If you look here, we have done an investment. Hamad has done an investment. An investment is capital, yeah? Investment into the business. It equals capital, and capital is credit by nature. An increase of a credit is credit. So we have credit capital. Okay? The amount is 100,000. Do you understand?
Yeah.
Second, he purchased computer worth 500 paying cash. Again, if we look from the perspective of cash, every transaction becomes very easy. If cash is coming, debit. If cash is going, credit. Yeah? So in this specific scenario, we have the same thing, this above. But instead of an increase, we have a decrease. Yeah? And decrease of a debit is credit. Okay. So our credit cash. Remember, it doesn't matter whether you credit first or debit first. The result would be the same. Okay. And what happens to the other side? If you look at here, what did we buy? We bought computer. What is computer?
An asset.
It is an asset.
So, yeah, asset increase, so we record it.
Is an asset, and assets are debit by nature. In this specific scenario, it has increased, so debit. Remember, these things is not part of double entry. These things, I'm just using it for the first time so that you can understand. I will not use them in the future, okay? Because today's topic is double entry, I need to go a little bit in details. So debit, computer. Amount was 500. So 500. Next. Purchase machine worth 1,000 on cash. What is machine? Asset, just like computer. What is computer? It is an electronic machine. So it is also an asset. And also if you look from the perspective of cash, cash is going out. So it is exact same scenario. Yeah? Cash asset decrease. But instead of computer we have another machine. But another machine is also an asset. An increase of that is debit. So debit, machine, and credit cash. Okay? And the amount is 1,000. Okay? Next, purchased goods worth 2,000 for resale on cash. Let me explain what is goods. Goods are things or items bought for resale. And the things bought for resale are called purchases. We call them purchases. SEC books call it purchases. And it is an expense. This is a very strange rule which you will understand in the future. Those things, whenever I'm speaking, then listen. Then you will not. It is not important to write it. Like you already have this copy. Yeah. So remember, this is a very strange rule that when you buy something for resale, it is expense. But when you buy something for use, it is not an expense. Like, let me give you an example of this projector that is here. Yeah? I bought it and I use it in the class. For me, it is an asset. And from the shop that I bought, for them it is not an asset. It is an expense for them when they buy it. I'm saying it is a very strange rule. So it is not what you buy. It is how do you use it? Do you sell it or do you use it in the business? If you are going to use it, it is an asset. If you are going to sell it, it is an expense. The reason we record it as an expense is because if we sell it, it is a sales. Yeah, when we sell it, it is sales. And sales is income. And the opposite of income is expense. If you sell something that is an income, and then when you buy it, it should be an expense. Because these two are opposite of each other. Yeah? In manual accounting, this is what happens. In manual accounting, first we record it as an expense. Then at the end of the year, whatever is remaining is called inventory. And that inventory is then an asset. Okay? So why do we buy projectors, for example, if I have a shop? To sell it. If I want to sell it, let's say in 2017 I buy some projectors, I want to sell it, the whole thing. If I want to sell the whole thing, then it would be an expense. So my intention is to sell it. If they are not sold, at the end, the remaining would be inventory assets. Understand?
Yes.
This is now in computerized accounting, like in QuickBooks. When you buy it, first they record it as an asset. Then when you sell it, they record it as an expense. Because computerized accounting, it is automatically updated. Yeah? In manual accounting, we cannot update it every day. Yeah? Because it would be a very headache. So what we do in manual accounting, we say if you buy it for selling, record it as an expense. Then at the end of the year, we will decide whether there is something remaining or not. If something is remaining, that would become an asset. If it is not remaining, then the whole thing became an expense. Do you understand that?
Yes.
This is the same rule as for accruals and prepayments. You will study accruals and prepayment in the future. In accruals, they say, whenever you pay for something, rent or whatever that is, first record it as an expense. Okay? At the end of the year, at the end of the year, then we decide. If something is advanced, it will become an asset. Understand? So, whenever you see the word goods, it means purchases, and purchases is an expense. It is a very strange idea, but you will understand eventually. Okay? So we bought goods, and what did we pay? We pay cash. So let's do the cash part first. So I can copy this exact same thing and credit cash. Okay? So we have purchases here, the second one. I told you that when you buy goods, it is purchases, and purchases is an expense. An expense is debit by nature. In this case, it has increased. So, debit. Debit purchases. Another qualification, they call it merchandise or something.
Merchandise.
Yeah. 2000. Understand?
Yes, sir.
So yeah, let me number it. 1, 2, 3, 4. Next. Purchased goods worth 1,000 on credit from Ahmad. Now, we bought goods. Remember, when you buy something on credit, when you buy something on cash, it is purchases. The debit side does not change. Okay? The only side that changes is the credit side. So I want to explain something else. Trade payables. Another qualification called account payables. But trade payables is a good word. Yeah? These are businesses, organization, or whatever, from which goods are bought on credit. Okay?
Yes, sir.
Only those organizations from which we buy goods. There could be other organizations from which we don't buy goods. For example, this projector I told you about. I buy this projector, it is not goods for me, but I just use it, yeah? It is a one-time thing, yeah? So trade payables is regular thing. And you will study later that we have separate books for them. For trade payables, we have separate books. Okay? So, and they are equal to
Liability.
liability. Okay?
Yes, sir.
So remember, the debit side of the transaction still remains the same thing. Whether you buy something on credit or on cash, it is the same thing. So debit, purchases. But the credit side changes. Instead of cash, now we have trade payables, TP, and that trade payable is liability. And liabilities are credit by nature. In this case, they have increased. An increase of a credit is credit. Yeah? So credit, trade payables. The amount was 1,000, yeah? Okay, so let me bring the rule below. Next, sold goods worth 2,000 on credit to Khalid. I want to talk about something else here, trade receivables. What is trade receivables?
Asset.
Yeah, they are businesses to which goods are sold on credit, and they are equal to assets. If you buy goods from someone on credit, it is liability.
Yes.
That is the opposite of when you give something to someone on credit as an asset. These should be opposite. They're opposite of each other. And remember, I told you in the definition of asset and liabilities that asset and liabilities are opposite of each other.
Yes.
What is liability for one would be an asset for another. Okay? So when we buy on credit, it is liability. When we sell on credit, it should be an asset. Yeah? Let me give example here of Ahmad and Khalid. Yeah? One is the relationship of Hamad and Ahmad, and another is the relationship of Hamad. I'm talking about business relationship. Okay. Okay. Khalid. From Ahmad, Ahmad buys. Yeah. So he records like this: debit, purchases, credit, trade payables. Ahmad would record the opposite of that. He would record debit, trade receivables, and credit sales. Understand? So this is a liability that is an asset. Remember, here it is liability. For one person, something that is a liability. For another person, in most cases, that is an asset. And what is an expense for Ahmad is an income for Ahmad. So this is an income. This is an expense. So what is expense for one is an income for another in most cases. Okay? So this is one side of the transaction. There is another side of transaction. Okay? Let's look at Ahmad and Khalid. Now Ahmad makes sales to Khalid. Yeah? So he records. Yeah, let's complete this, then come back. Okay? So the transaction was sold goods worth 2,000 on credit to Khalid. Remember, when we buy goods, we call them purchases. But when we sell them, we call it sales. Buying is opposite of selling, yeah? If buying is an expense, selling would be an income. So let's start from that point. Sales is an income. And incomes are credit by nature. In this case, it has increased, so credit. So sales. Now, if we buy on credit, it is trade payables. If we sell on credit, it would be trade receivables. Trade receivable is an asset by nature. An asset equals debit, and in this case, it has increased. Okay? Debit. So debit, trade receivables. Outside there is socket, bring it. The water dispenser. Okay. So yeah, as you can see, this is the exact opposite, these two entries. So the amount is 2,000. Ci vuole ci sta avanzando. Okay, so let's talk about the relationship of Hamad and Khalid. I wrote Hamid. This is Hamad. Remember, when Hamad makes sales, it is credit sales and debit trade receivables. Now the scenario is opposite for Khalid. For him, it is debit purchases and credit trade payables. Okay. So sales into purchase, trade receivables into payable. Yeah? What is one thing for one person is another. What is expense is income. Liability, asset. Okay. Let's look at another transaction. Sold goods worth 1,000 on cash. Remember, I told you that when we buy something, whether on credit or whether on cash, the debit side does not change. The same thing is in sales, but the credit side does not change. The debit side changes, but the credit side does not change. As we can see here, we have debit purchases, yeah? But the credit side changes. It is credit cash, credit trade payables. The same thing here, if we sell something on credit, it is a sales. Yeah? So credit sales. But the thing that happens is, like we did in the first transaction, we have a cash that we receive. Yeah? So cash increases instead of receivables. So debit, cash. And the amount is 1,000. Okay? Next. Took out loan from Kabul Bank. When you take out loan, what do they give you? What is loan? You go to Kabul Bank and you give them loan. What are you asking for? Cash. Cash. You are asking for cash. So they give you cash. So very easy. This is cash.
Sometimes car.
Yeah.
Sometimes
They don't give you car. You take money to buy car for it, but they don't give you car.
Bank is not.
There is called finance. There is called finance lease. عربي lease ده غم غبل شيء lease. هذا finance lease one. There is finance lease. There is something else. It is a kind of a loan, but it is called finance lease. The treatment is different. Okay. So yeah, we receive cash, debit cash. And yeah, now when they give you loan, they don't tell you, okay, take it and go. Don't come again. Yeah? They will ask it back. So what is loan? Loan is payable. Yeah? Loan is a liability. Loan equals a liability. And liability is credit by nature. So increase would be credit. Kabul Bank is very old bank. I'm using very old examples. Maybe I should use IIB. So credit, loan. 6,000, yeah? And notice one thing here, that I didn't write the name of the people. See, I didn't write here Ahmad, I didn't write here Khalid. We will understand that. You will study later. In double entries, we don't write names. Okay? So some people will write debit Ahmad or credit Khalid. It is not true. Okay? Double entry, you go to general ledger. This thing specifically we will study in chapter called control accounts. Okay? In control accounts you will understand why we don't write names in double entry. Okay?
Sir, but I look at expense like
non-liability.
liability.
بس هو اللي دارج يبوك بان شو ده ولا؟
Sir, in here that you have said that you know the liability.
Yeah.
Because once
and liability definition that once I said it is the claim of outsiders against the asset of an organization.
That is not correct.
That's
That is not complete definition. It is correct up to some points. What definition I give you, that is
It's an
complete.
obligation.
It is an obligation.
Pass
Yeah. You get it?
If
So there will be an outflow of economic benefits.
outflow.
Now, how is that in case of loan? You take out the money from bank, they will ask it in the future. Isn't that outflow of economic benefits? That is, yeah? You will give the money back. This will have an outflow of economic benefits.
So in case if we could not give, so maybe we have something in guarantee.
Yeah.
So we'll definitely, so it's allowed.
That is F9 topic. So, yeah, paid salary to staff of 1,500. Remember, I told you when I explained expense and income that rent, discount, salary, when you pay, it is an expense. When you receive it, it is an income. So salary is not an expense. When you receive it, it is an income. Yeah? So, when we pay salary, what do we pay? We pay cash. Yeah? So remember, I told you whenever there is cash involved, start from the cash. That is the easiest part. Automatically, the other side would be debit. So credit,
We pay salary.
cash, and salary paid is an expense. I will not say salary is an expense, or say salary paid is an expense. An expense are debit by nature, and in this case, it has increased. Debit. Debit, salary, expense. Okay, 1,500. Next, paid 500 cash to Ahmad for the goods that he had bought on credit. If you look at transaction number 5 here, we bought goods from Ahmad on credit, and here we paid back 500 of that money. The total amount was 1,000, but we paid back 500. Yeah? It's okay, zyada ho gayi. So yeah, transaction 10. Again, when we pay money, cash outflow, credit cash. But trade payables, liability equals credit by nature. In this case, it would decrease. When you pay someone money, you will pay less in the future. It will decrease, yeah? So trade payable is a liability. It has decreased in this specific scenario. So debit trade payables, 500. Okay. Next, received 700 cash from Khalid for the goods that he had sold on credit. If you look at here, we sold goods to Khalid. In this scenario, we received money from Khalid. So it is this scenario. Okay, debit cash. So debit cash and trade receivable. Remember, it is an asset. When we give money to someone and it decreases our liability, when we receive money from someone, it decreases our asset. Yeah? So that is debit. Decrease of that is credit. So credit, trade receivables. How much is it? 700. One asset increases, another decreases. Let's go back to this scenario. When we make payment to Hamad makes payment to Ahmad, he will record it like this, like we just studied above: debit trade payables, credit cash. But Ahmad receives the cash, debit cash, credit trade receivable. He decreases his asset. The decrease of liability of one is the decrease of asset of another. Cash received for one, paid for one is cash received for another. And the same thing is here. They record debit cash, credit trade receivables. This will record debit trade payables and credit cash. The decrease of asset is decrease of liability for them. The received cash is cash paid. Okay? So accounting has links. If you understand that link, that is very interesting. Yeah? So 12. Paid 2,000 to the bank for the loan that he had taken out. So we took out loan from bank and we paid back some of that money. Yeah? Again, when we pay money, it is credit cash. Yeah? So exact this scenario. So credit cash. Any transaction involving cash is very easy. And then what happens to the loan? Loan liability. Liabilities are credits. It decreases. Decrease of a liability is a debit. Yeah? So debit, loan. Okay? The amount is 2,000. 13. Paid rent for the month of January. Remember I told you rent, salary, paid is an expense. Yeah? And again, what happens to cash position? Cash decreases. So credit, cash, and rent paid is an expense. And their debits, they have increased debit. Debit, rent, expense. How much was it? 500? Paid interest to the bank on the loan that he taken out. Remember I told you, interest was also in that. Interest paid is an expense.
Yeah.
Received is an income. What is interest paid? Increase of interest expense is increase of liability. Yeah, increase of liability is also an expense. So 13. We paid actually the money here. So credit, cash, and then we have interest expense. Interest paid, sorry. Interest paid equals expense, and it has increased their debit, they have increased debit. So debit, interest, expense. 100. Yeah? The other two will not come here, so next page. Let's look at the last two. Okay, no, last one. I made a mistake in numbering. We left some, yeah, this is 14. This is 13. This is 14. Let's find space for it here. Yeah? Let's don't waste paper. But it is electronic paper. It will waste your space. So again, transaction 15. Bought a car. Again, what is car? Car is machine, asset. Yeah? And we paid money for it. So credit cash. So credit cash. And car, an asset. Assets are debit by nature, and they're increasing. So debit. So debit. Car. Okay. How much was it? 1,000? What kind of car is it? Maybe it's orange.
That time is Sweden start.
Yeah, I will give you the the recording. Check it again, okay? Maybe you are hungry today.
Volta a